Welcome back to Silver and Metal IQ, the channel where we break down the real story behind gold and silver, without the noise, without the hype, and without the fake predictions. I'm Peter, and today we're going to talk about something that most people are missing completely. If you think silver is just another commodity, you're about to see why this moment is far bigger than a simple price chart. Here's the hook. There are only 13 days left before a major deadline that could shift the entire silver market. Not in a week, not next month, but right now. And the reason this matters is not because of speculation or leverage. This time, the big money is not trading on margin. The big money is buying real metal and standing for delivery. And we're talking about the most deliveries ever recorded in the history of the COMEX market since 1974. That's not a coincidence. That's a structural event. This is not about short-term traders trying to make a quick profit. This is about sovereign wealth funds, governments, and major industrial buyers competing for the same physical metal. And when the market is this tight, paper price movements no longer matter. The paper price can fall, rise, or stay flat, but the physical market is the one that determines the future. And right now, the physical market is screaming one message: silver is becoming scarce. If you've been watching the news, you've probably seen the usual talking heads telling you the top is in, that the bubble has burst, or that silver is no longer a safe bet. But those people are missing the bigger picture. The top is not determined by a chart. It is determined by supply and demand, and right now, supply is shrinking for the 6th year in a row, while industrial demand is exploding. AI, solar energy, military applications, electronics. Silver is being consumed faster than it can be mined. And when the biggest buyers in the world start standing for delivery, it's a signal that the market has entered a new phase. So, stay with me, because in the next parts, we're going to break down what's really happening behind the scenes, why banks are trapped, why lease rates are exploding, and why the old paper-based system is starting to collide with reality. This is not a normal cycle. This is a structural shift, and it's happening right now. All right, let's get straight into it. February 1st, 2026 is not a random date. It's the day a new policy comes into effect that will change the rules of how silver moves into the US market. And the moment the clock strikes midnight Eastern, the supply chain that you've been relying on could start acting like a completely different market. Now, the mainstream narrative is all about politics. They'll talk about trade disputes, diplomatic pressure, and retaliation. But here's what nobody wants to admit. The market doesn't care about politics. The market cares about logistics. It cares about flow. It cares about whether silver can be delivered quickly, efficiently, and at a predictable cost. Because when you're dealing with physical metal, delays and friction are the same thing as shortages. And this is where the real problem begins. Because the policy in question is not about confiscation or banning silver. It's about adding friction, delays, higher costs, complicated paperwork, and longer shipping times. It's the kind of policy that doesn't need to be dramatic to be devastating. It just needs to make it harder to move silver. Here's the thing. If you can't buy silver at a price that makes sense, or you can't buy it at all, the result is the same. You're locked out. Now, the reason this matters is because silver is not like gold. Silver is not only a monetary metal, it is also an industrial metal. It's used in electronics, solar panels, medical devices, and countless other industries. And these industries don't stop just because there's a tariff. They keep consuming, they keep demanding, they keep paying. So the real question isn't whether the tariff is 10% or 25%. The real question is, what happens when the supply chain gets squeezed and demand stays the same? Because that's when premiums explode. And that's when the paper market and the physical market stop moving together. You see, there are two silver markets: paper silver and physical silver. Paper silver is easy. You click, you buy, you feel like you own something. But that's not the same as holding metal in your hands. Paper silver is a price position. Physical silver is an ownership position. And in a supply squeeze, paper can stay calm, while physical becomes extremely expensive and difficult to get. This is the point where most people get blindsided, because the price on your screen can stay normal while the premiums in the real world are already screaming. So if you're watching this and you're thinking, it's just 10%, think again. 10% is not a small number when you add insurance, shipping, storage, and the risk buffer that dealers and wholesalers add when they don't know what the next shipment will look like. Costs stack, and once that stacking starts, it doesn't stop. That's why February 1st is not just a date, it's a deadline, and deadlines create panic. Because people don't react to the future, they react to the last moment before the future hits. Now, here's where most people get confused. When they hear about global silver supply, they picture mines, coins, and bars stacked in vaults. But the truth is far more complex, and far more dangerous if you don't understand it. Because silver liquidity is not just about mines. A huge amount of the world's silver supply exists in the form of refining, vaulting, and distribution networks. It's about infrastructure. It's about plumbing. And one of the biggest plumbing systems in the world is in London. London isn't just a financial city with bankers and headlines. It is a vaulting hub, a standard-setting hub, a pricing hub, and it plays a massive role in the physical movement of silver. When people talk about LBMA, good delivery bars, and vault holdings, they're not speaking in financial jargon to sound smart. They're describing the actual system that makes silver available when buyers need it. And here's the key. Just because silver exists somewhere doesn't mean it can be delivered to you. If the system that delivers it gets disrupted, the metal may as well be locked behind glass. So why does London matter? Because London is a major hub for institutional silver. A lot of big entities store silver there, and it's tied into the global distribution system. The silver may be real, the supply may be real, but the deliverability is the real issue. And this is where the tariff becomes more than politics. A tariff changes the economics of movement. It changes what wholesalers can quote. It changes whether dealers can restock without blowing out premiums. It changes who can profitably import. And when the economics change, the supply chain reacts. Because in retail silver, margins are thin. Dealers don't make huge profits per coin. They make money on volume. They need predictable sourcing, predictable shipping, and predictable costs. So when a 10% tariff hits a major import lane, that lane can become unworkable. And when one lane becomes unworkable, everyone starts fighting over the remaining lanes. That's when availability becomes the real price. And this is where people start to panic, because they realize the supply isn't out there anymore. It's becoming hard to reach. Now let's talk about the two markets again, because this is where the trap gets set. The paper market is easy. The physical market is not. In a supply squeeze, the price on your screen can stay calm while physical premiums explode. That's because paper doesn't require delivery. Physical does. So you can end up in a situation where spot price looks calm, your ETF looks calm, but real silver in real hands is being sold at much higher prices. And that gap is not a theory. It has happened before. It happens when supply gets tight. So if you're watching this and thinking, it won't affect me, you're missing the point. Because the point is not whether silver exists. The point is whether you can get it when you want it, at a price that makes sense, and without being forced into a panic buy. And that's exactly what this tariff deadline is threatening to do. Now let's break down what actually happens when a tariff hits. Because the danger isn't the number on the tariff itself. The danger is the way that number ripples through the entire supply chain, stacking costs on top of costs until the final premium becomes far higher than anyone expected. A 10% tariff sounds manageable on paper, but the reality is that tariffs don't arrive alone. They arrive with shipping delays, higher insurance, longer financing, extra paperwork, and the risk buffer that every professional dealer adds when the future becomes uncertain. In other words, a tariff is not a single cost. It's a cost multiplier. And this is where most people miss the point. They think 10% isn't a big deal. But if you're building a position, that 10% is not just a fee. It becomes a domino effect. It raises the declared value. That raises insurance costs. That raises financing costs. That raises handling costs. And suddenly, the price you see at checkout becomes a number you didn't plan for. That's how disruptions always feel bigger than the headline. But the real problem is not just the cost. It's the behavior it triggers. A tariff deadline creates urgency, and urgency creates panic buying. Because when people see a date approaching, they stop thinking like rational investors and start thinking like people who are about to miss out. They wait, they delay, they dismiss it as politics, and then, at the last second, they rush in together. And when everyone rushes at once, the shelves don't care what you believe. They just empty. That's when premiums become the real price. Because in a shortage, the market doesn't negotiate. It ration. Dealers raise premiums not because they want a profit, but because they need to slow demand. They need to keep inventory from disappearing overnight. They tighten product selection. They shorten quote windows. And if you're someone who planned to wait until after February 1st, you might be shocked to find out that after doesn't mean cheaper. It might mean gone. Now, this is where the industrial demand angle becomes critical. Silver isn't only a stacker metal, it's a working metal. It is used in solar, electronics, medical devices, and many industries that cannot simply pause production. These industries have contracts, certifications, and production lines that don't stop because a tariff is announced. So when supply tightens, industrial buyers don't say, "Let's wait." They scramble. They pay. They outbid retail buyers. And retail buyers get pushed to the back of the line. That's the hard truth. So the key idea here is simple. The supply squeeze doesn't start when the tariff hits. It starts when people realize it will hit. And that realization spreads faster than the tariff itself. Because once buyers start acting, the supply chain starts reacting. Wholesalers begin to hoard. Dealers begin to raise premiums. And suddenly, the market splits into two groups. People who already have metal and people trying to get metal. The second group pays whatever it takes, if they can even find it. That's why the timeline matters. This is not about February 1st being a dramatic day. It's about February 1st being the moment when the system officially changes. And in markets, systems don't change quietly. They change with friction, and friction creates chaos. If you're watching this and still think you can wait, you need to understand something. Waiting is not a strategy. It's a bet that the market will stay calm while the supply chain becomes tighter. And in the silver market, calm is the illusion. The real market is the physical market. And the physical market reacts first. Now we need to talk about the part most people don't want to hear. There are two silver markets. The one you see on your screen and the one you feel in your hands. The screen market is the paper market. It's easy. You click a button and a number changes. You feel like you own something, but you don't actually hold metal. That's a price position. The physical market is different. Physical silver is ownership. And in a supply squeeze, those two markets stop moving together. Because paper silver doesn't require delivery. Physical silver does. And when the supply chain gets squeezed, the physical market becomes the real game. Spot price can stay calm while physical premiums explode. Your ETF can look stable while dealers are charging 30% or 40% above spot. That gap is not a theory. It's a real-world outcome when supply becomes tight and demand stays sticky. And demand is sticky because silver isn't just a collector's item. It's a working metal. Solar panels, electronics, medical devices, these industries don't stop because a tariff is announced. They keep consuming silver because their products depend on it. And when procurement teams sense a disruption, they don't wait for social media to argue. They start buying immediately. They outbid retail buyers. And suddenly, retail orders are pushed to the back of the line. That's why industrial demand becomes forced demand. And forced demand does not negotiate the way casual buying does. Now, let's talk about inventory numbers, because people throw them around like they mean something. COMEX inventory is not one pile. It has categories. Eligible is metal that meets specs and could be delivered if the owner chooses. Registered is metal tagged and ready for delivery against contracts. Those are not the same. And in stress scenarios, Eligible does not automatically become registered. Owners can keep metal eligible and refuse to deliver. So when you hear a big inventory number, your next question should be, how much is registered and how fast is it shrinking? Because registered inventory is the part that gets squeezed first. When registered inventory drops and delivery demands rise, exchanges respond by pulling levers. They raise margins, they change rules, they encourage cash settlement, and every lever pulled sends the same message: physical is tight. That message triggers more buying, which triggers more squeezing, which triggers more panic. That's how these events become self-feeding. And here's the part that matters most. Spot confirms late. Premiums confirm early. Availability confirms immediately. If you wait for the chart to prove the problem, you're already behind. Because the market doesn't need the spot price to rise for the physical shortage to be real. The shortage becomes real in the supply chain first, in shipping, in restocking, in dealer quotes, in delivery windows. And by the time spot price catches up, the opportunity has already passed. So if you're still watching and thinking this is just another story, remember this: silver doesn't punish people for being wrong on direction. It punishes people for being late on availability, and that's the central lesson. The market doesn't care whether you were right or wrong. It cares whether you have metal when you need it. Now, let's bring this home. The key idea is simple. February 1st is a hard date for a soft market. Even if you think the politics are noise, the supply chain impact can be real. Because the tariff doesn't need to ban silver to lock you out. It only needs to raise friction enough that normal flows slow down. And in a tight market, slowing flows is the same as removing supply. That's how premiums explode. That's how availability dries up. And that's how people end up holding regret instead of metal. So what should you do? First, decide whether you want a price position or an ownership position. If you want ownership, you need physical metal in your hands. Second, prioritize speed and reliability over chasing the lowest price. In a disruption, the lowest price is often the one you never get. Third, don't overthink it. Pick a reputable dealer, place the order, and move on. Because the worst decision you can make is waiting for perfect timing. Perfection is the enemy of action. A small position now is better than a perfect position too late. Now, I want to be clear about something. This isn't financial advice. I'm not telling you to buy or sell. I'm explaining the mechanics of a market event that could impact availability and premiums. If you choose to act, you should do your own research and make decisions based on your own situation. And if you're unsure, consult a qualified financial professional. Before I go, I want to remind you of the real danger. Waiting is not a strategy. The market doesn't wait for you. The supply chain doesn't wait for you. And once the squeeze begins, it doesn't care about your timeline. It only cares about who gets metal first. If you already have silver, audit your holdings. Know what you have, where it is, and why it matters. If you don't have any yet, start small and build. Because the truth is simple. In the world of physical metals, availability is the most valuable currency. If this helped you connect the dots, hit subscribe, leave a like, and comment OG John AG so I know you're backing the original work here. Check the description for the bonus links, the premium WhatsApp channel, and the membership options, including the members' only deep dives. And if you have a success story or a question, drop it in the comments. I read them all. Take care of yourselves, take care of each other, and I'll see you in the next update.